Good morning, traders and investors around the world. Welcome to this Thursday, January 27th edition of Pre-Market Prep with Stock Odds. Joel Elconin, joined by the venerable Rob Friesen here. On just another day in the markets, there's really not too much going on besides a 160-point range in the S&Ps when you include that overnight range. Caught a nice bid off the open, and we were just going higher and higher and higher and higher. And then we hit 42, 44, 22, well ahead of Friday's high, and we whipped it around. Now we're only up 31 and a half handles. Let's call it 32. Making new lows on the intraday session. We really only got 110 points to fall to get to the pre-market low. I'm going to go out on a limb, and I'm going to make a prediction, and I'm going to say that we don't drop 100 handles to the pre-market low, but anything could happen in this market, right? Crude, big reversal, got near 89, now in the 86 handle. What a volatile instrument. Down 76 cents at 86.56. Gold right back to 1800. Just when you thought it was safe to step in the water at 1840, they slam it down to 1800. Down 31.50 at 1840. Silver in the red by over a stick at 22.72. Bitcoin trying to get back over 40K, but running into problems ahead of that. Down 460 at 36.615. Ethereum, it's going about the same way. Ooh, different looking chart from Ethereum than the Tesla, but that's down $41 at 24.7650. I'm going to stop the screen share here and Rob, I mean, you want volatility, right? Volatility is a good thing,
Well,
right?
first, it's nice to have predictable relationships and, have some data and then have volatility. Volatility just by itself, where's your reference point? I mean, it'd be like, just think of yourself, that movie Perfect Storm where they were in the big waves and, which way was north, south, east, west? Without a compass, without knowing which way you're supposed to go, right? Waves, I mean, they're dangerous, right? So volatility, if you don't have a reference point, can be, you can just get run over, seriously.
Well, boy, did I just lob one up there to you and you just smacked it out of the ballpark.
I mean, you have to have a reference point. That's why let's just cycle back to when we actually had some serious things happening in 2007, where we market had hit a new high, and they eliminated the uptick rule. And then about 2 weeks after that, we started to get a pretty serious problem. And we had volatility suddenly hit, because in April we had the historical volatility down around 6. It was super low, and the leverage was just piled on all over the place because returns were so minimal because of low volatility that they had to use more leverage. Well, then roll a couple months later and you've got that scenario of the uptick rule is eliminated. It goes back to unintended consequences. I mean, we're getting the same problem here with what's happening with Omicron, and all of the things that were put in place for COVID are now kind of bottlenecking everything with something that's becoming more endemic. Like everybody I talk to has it, kind of thing, So my point is, you can't have the same framework dealing with something that's more endemic than you had when the concern was much greater. So unintended consequences. There's always issues with policies and regulations. They can be right, they can be wrong, but a lot of times there's unintended consequences. So they eliminated the uptick rule. We had like price to perfection, massive leverage, and then things started to come apart, right? Bear Stearns, first thing, and so on. And I was in Germany at the time when I actually got on the plane and flew to Germany the day that things blew apart. So I was in midair when things started to come apart. when I was able to talk to the traders, I said, listen, you got to roll into contractual class arbitrage type spreads, right? Because, example, you might have something like Dillard's on against Kohl's, which was acting really well before things started to blow up. And you might even had the value stock long and the growth stock short or whatever, but it starts to come apart. That's volatility hitting it in a way that's not beneficial. So what do? You've got to come and switch into something that has more reason to stay together. There's like a merger, has a contract, like two stocks that are the same company, like Under Armour and Under Armour, UA and UAA, they're the same company, two classes of stock. When volatility hits that relationship, you can make a lot of money. When it's quiet and no volatility, it's really hard to make a lot of money. You have to size up more, you have to swing trade it more. But intraday, if you want to make a lot, those types of relationships can be really, really good. So just remember, you need predictability first before you just get raw volatility. If you have raw volatility with no framework, no reference point, you can really get lost, like you're out at sea without a compass. Make sense?
Yeah, I like that. I like that. Just, I mean, it's something that you've been pretty consistent with since we started doing this afternoon show, or this mid-morning show, early morning for you, is that, changing strategies with changing markets. They're going up like this and going up like this and going up like this, is a different market than definitely what we're having now. So
Well, that's why, I like taking the snapshot at the end of the day and asking questions of the market in terms of what was favored and possibly why. Okay, so that helps you tune into how much pre-screening should you do, how much should you rely on the stats. If we go back to the 6 pillars, which are fundamentals, technicals, statistics, historic relationships, sentiment, news, and macro forces, not necessarily in that order. But your job as a trader is to ask the question, what is the market most concerned about now? Is this really just a sentiment trade? Is this deleveraging for a reason? Is this, rotation? Is this all of Warren Buffett's crowd coming back into the market and going, let's buy all the value stuff? You have to ask the questions, what is going on? That's the only way you're relevant for the next day. As a trader, you have to be relevant each day. How do you get that unless you analyze what has happened and possibly why? Right. So one thing I wanted to bring up about seasonality is, let's just can I share my screen for a second?
yeah, let me oh wait, did I read it? No, yeah, you're free. I'm
Okay.
not you don't have mine. I see my ugly
Okay,
mug.
this is coming to say we're at the end of the month here pretty soon. January 31st is on Monday, so
Correct.
last trading day of the month. So looking at things that you might put some emphasis on, last days of the month, first days of the new month, expiration, like mid-month seasonality, end of month seasonality. Those are kind of the more dominant focuses. But you have to also look at what symbols might be coming up and why. So if you look at the list here, how many of those are meme stocks in the top? Well, all of them, really. Those top 4 are meme stocks, right?
Uh-huh.
So wouldn't you say that because of last January, that if you look at the last day of the month, there was some window dressing that occurred, plus some mob behavior in those names? So I have to take those out.
Nice.
Right?
Yep.
Okay, because they had, let's just say, for example, that you had for, say, the last 7 years or 8 years, you had maybe 1% variance. So you have an edge. You have sort of a positive expectation for those stocks because of seasonality. But then all of a sudden, one of the years on that particular day, you get 40%, 50%, 200%, 500%. I mean, that's going to completely skew the numbers.
Distort, yeah.
So two things to check on seasonality if you're using it to curate. It's not so bad if you're using it to curate ETFs, although some ETFs were affected. For example, IWM was affected by AMC for sure.
And the retail ETFs too.
Right, and the retail as well. Yeah, absolutely. So you have to be aware of some of the ETFs, but they're not so bad. But if you get into the individual stocks, there are some times where you have events that have occurred. Okay, so let's just roll back. February and March and April of 2020, the airlines were extremely impacted. Discretionary stocks extremely impacted. So remember that. In January of 2021, you had short squeeze City, and you got a lot of different things that were popping up on the memes. There was like between 20 and 35 type meme stocks that you got to be aware of. So if you just come across those names, check that, but also check for prices. So for example, some of the ones over here, used to be trading at, 20 or 30 or $40 a share, and they're trading at under $5 a share. So as you're approaching it now, yeah, it says, okay, it's favored to go down, but what's the price of the stock? It, like this one here, was 1266 and it's at 350 now, and this one here was at 1374 and now it's at like under, I think it's about 369 or something. So the point is, check prices that are current, check overall framework in the group or the sentiment kind of thing, and check for meme stocks and things like that. As we go on in time, throughout the year, the rest of the months aren't so problematic. You pretty much just have to watch for the seasonality calendar related to January and that, sort of February through April. Those are the months that are most whacked out. I mean, it'd be no different than if you were an oil's future trader. Remember 2020, we had April-May contract. I think it was it was the May contract, but it would happen in April. Oil went negative. Never happened in history before on the futures. So if you were using data points and you were, looking at statistical data, would that negative oil contract not throw things off?
Oh, totally distorted. Yeah.
That's all I'm saying. If you're using seasonality or you're using any type of data, this is where I think sometimes machine learning and all that other stuff can end up with a problem, is because it doesn't have the
historical context.
It doesn't have the human insight to say, hey, wait a minute, there's something wrong with this data point, right? It's like it'd be like it could be like a Tesla braking for a road sign or something, that happened to be hanging over a little bit differently. It's like a human would have just discarded it, but the computer goes, I think this is an object I need to brake for. So there's issues with digital intelligence. Just remember that the human needs to supervise, the human needs to verify. Okay.
Yeah, that's excellent, Rob. I really like that. That's just part of your experience in the markets, taking different situations and applying them to the now. So that's great. I really like that segment. Anything else for today, Rob, or you wanna wrap it up?
No, just be aware we could still, we can still see a bounce because we are post-Fed. We're kind of digested it. I don't think we got the clarity and the language that we were looking for. I think don't mean to be harsh or anything, but I think the more that Powell was talking in the Q&A period, the worse the markets were becoming. I just think that, you know, it was kind of like the babble that was like, well, we're not really getting anything, and this is making it sound like there's no confidence or something like that, right? So, you know, that's why the market, you know, sold off there.
Okay.
And we're not out of the woods, but we do have a little bit of a, you know, a backdrop is that, you know, we are discounted now. If things can stabilize, there is room to sort of build on this, because we are expecting, you know, the odds are what, 86% or something for a 25 basis cut hike in March, and then 14% for a 50. It could be higher than that. It could change as we get closer to it. But I think the market's kind of figured out that, hey, we're going to have the hike. You know, we got to deal with this. So it's possible to rebuild from this level, but we're not out of the woods yet. It is choppy, and you still have to have your trader hat on. There's a lot of noise, you know, to benefit from there. So, and the other thing is, one of the clues to today's rollover from our highs was the breadth of the market. You started to see that turn, and also Bitcoin turned and went down from its rally. And so both of those were pretty good indicators for the SPY dropping this last 30 minutes there. So, okay.
Okay, pal. I like that. Great information. We'll be back tomorrow. Pre-market prep with StockOdds closing out here. We're still up 36 handles on the day, 43.7750. I didn't even look. What did we had? 120, so 60. So we're still long ways. Is that right? No, 100. Wow. Let me do the math on here just to get this right for you guys. Because you know what I like to look at intraday. I'll go to my trusty retracement tool on my trade station. And what does it give me here? Oh, it kind of looks like, oh, here, I'll do it. 100, yeah, 160, 80 points. So I'll look at that close area, man. That's going to be big. We had two closes. The low close of the move has been 43.41. We had a previous day's close of 49.50. So why not? Why not come down and settle right in that area today and set things up for tomorrow? So that's what I'm looking at. On the upside, I think we're going to have problems getting back into that 4,400 handle, but anything can happen. Folks, have a good day. Back with you with 3:30 at the close.